People always wonder what it was like in those final moments before catastrophe. They want to know if anyone saw it coming, if the signs were flashing red, if someone stood up and screamed a warning that went unheeded. The truth about October 1929 is stranger than most people realize. The crash wasn't a surprise that emerged from nowhere. It was a disaster that was telegraphed for years, whispered about by the few who were paying attention, and then completely ignored by the vast majority of people whose life savings were about to vanish. The United States in the 1920s had something no nation had ever experienced before in this way, a stock market that seemed to only move in one direction. Up. Always up. And when everyone believes that, when the belief becomes so total that doubt itself seems foolish, when the skeptics are pushed to the margins, that's when the system begins to crack from the inside. This is the story of how an entire nation bet everything on the idea that reality had changed forever, and how reality collected on that bet. The 1920s were America's intoxication, and the intoxication ran deep. After World War I, which had ravaged Europe and left the continent exhausted, America stood relatively untouched. The infrastructure was intact. The factories were humming. There was genuine wealth being created. Manufacturing boomed. The economy hummed with real productivity. There was money everywhere, or at least it felt that way. People had just lived through the misery of wartime, and now the party was on. Jazz filled speakeasies. Women wore shorter dresses. Cars rolled off assembly lines in Detroit at staggering rates, and people who had never owned a car suddenly could. Henry Ford had figured out mass production, and it changed everything. The prices of automobiles dropped. Suddenly the American dream wasn't just about owning a home anymore. It was about owning a car, a radio, a washing machine. It was about consumption and rising living standards and the belief that the future would be even better than the present. This wasn't hallucination. Real things were being built. Real productivity was increasing. Real wages were going up for many workers, but underneath the genuine growth was something else growing too, speculation, pure, naked, irrational speculation. And by the late 1920s, the speculation had absolutely dwarfed the underlying reality, become so enormous that it dwarfed everything, became the only story that mattered. The stock market became the center of this mania. In 1920, fewer than 3 million Americans owned stocks. By 1929, that number had swollen to around 10 million. But here's the key detail that most people don't understand, the detail that matters. Most of those stocks weren't being bought with actual money. They were being bought with borrowed money, margin buying, they called it. You could walk into a brokerage office with $1,000 in your pocket and buy $10,000 worth of stock. The broker would loan you the rest. You're putting down 10%. The broker covers 90%. As long as the stock price went up, this worked perfectly. You'd sell the stock at a profit, pay back the loan, and keep the difference. It was free money, except it wasn't. It was a trap that had been set a decade earlier and was finally about to snap shut. The mechanism was elegant and terrifying in its simplicity. A tailor in Brooklyn, a secretary in Chicago, a shop owner in Kansas City, an elevator operator in Manhattan, ordinary people with ordinary jobs and ordinary paychecks, suddenly had leverage into the stock market that they never would have had otherwise. They weren't investing in businesses they understood. They weren't analyzing balance sheets or diving deep into management teams. They weren't reading financial statements or thinking about dividends. They were simply betting that the stock price would be higher tomorrow than it was today. Pure speculation. And as long as new money kept pouring in from other speculators, as long as the wave kept building, the prices did go higher. It became a self-fulfilling prophecy, a cycle that fed on itself. The moment you believed that the price would rise, you bought. Your purchase drove the price up. This proved to everyone else that you were right. They bought too. The price rose more. And the cycle accelerated, faster and faster, until the entire system was moving at a velocity that nobody could control. By 1929, the stock market had entered a fever dream, a collective hallucination where reality no longer applied. Stock prices had more than tripled in the 1920s. The dividend yields on many stocks had fallen below what you could get from a savings account. Think about what that means. You could put your money in a bank and get a guaranteed 3 or 4%. Or you could buy a stock on margin, putting up 10% of the money yourself, and the stock was yielding less than 3%. In other words, the stocks were worth less as actual productive assets than they would be in pure cash. But prices kept rising anyway. Professional economists warned that valuations had become completely unhinged from reality. There were whispers in financial circles about a correction coming, about the need to pump the brakes. But whispers weren't louder than the sound of money being made. People were getting rich, or felt like they were getting rich. That's all that mattered to anyone. Money managers who suggested caution were fired by clients who thought they were idiots, standing in the way of their fortunes. Why wait for a safe investment when you could quadruple your money in the stock market in a couple of years? This is the dangerous moment in every bubble, the critical inflection point. It's when skepticism looks like cowardice, when prudence looks like stupidity, when the people who see the danger are pushed to the margins because they're standing between other people and their dreams of wealth. The warnings were real, they just didn't matter. The Federal Reserve, which had the power to slow down the speculation by raising interest rates and making money more expensive, faced a terrible dilemma. Raise rates and risk choking off the economic boom, throwing people out of work, possibly triggering a recession. Keep rates low and risk letting the bubble inflate even further until it inevitably popped on its own, possibly with even more damage. They chose the second path. It seemed like the safer option at the time. Throughout the late 1920s, money was cheap, interest rates were low, credit was abundant and easy to get, and the speculation fed on that abundance like a fire fed on oxygen, consuming it, demanding more, requiring endless fuel to keep burning. By the summer of 1929, the bubble had grown so enormous that even the people participating in it, even the ones getting rich, were starting to feel uneasy. Something didn't feel right anymore. Margin debt, the borrowed money fueling stock purchases, had reached astronomical levels relative to the actual value of the stocks themselves. We're talking about hundreds of billions in borrowed money, an amount so large that default would have cascading effects throughout the entire financial system. There were warnings from serious people. Yale economist Irving Fisher, one of the most respected economists in the country, a man who had built his reputation on understanding markets, said something stunningly tone-deaf in early September. Stock prices have reached what looks like a permanently high plateau. 2 days later, the market had its first major sell-off of the year. People panicked. They started selling. But then it rallied again, and the rally convinced everyone that the sell-off had been just a minor tremor, a healthy correction, a chance to buy more at slightly lower prices. This is a crucial moment in every collapse, the moment when the first warning tremor arrives and it doesn't kill the system. When that happens, when the system survives the first shock, confidence is actually reinforced rather than broken. People didn't learn from the September dip. They learned that they could panic, sell for a moment, then buy back in at a lower price and recover their losses. The cure was thought to be as simple as panicking and then calming down, but that wasn't how this trap worked. That wasn't how any trap worked. What nobody seemed to fully grasp, what people actively avoided thinking about, was the interconnectedness of the system. The stock market didn't exist in isolation like some beautiful garden separated from the real economy. It was woven into everything. Banks held stocks in their portfolios. The value of those stocks affected the bank's balance sheets. The health of the banks was the health of the entire financial system. If stock prices fell far enough, banks would face losses. If banks faced losses, they couldn't lend. If they couldn't lend, businesses couldn't operate. If businesses couldn't operate, people lost jobs. People had mortgages from those banks. If the banks failed, the mortgages were sold off or worse. Ordinary people who had borrowed to buy homes or start businesses suddenly found their loans being called in. Businesses borrowed from banks. If banks needed to call in loans to shore up their capital, businesses couldn't operate. Small businesses would close. Factories would shut down. Ordinary people had their life savings in banks. If the banks failed, the savings evaporated. You could walk in Monday and be told the bank had failed over the weekend. The whole financial system was built on a foundation of assumptions about future profit and growth that had become increasingly detached from reality. Nobody wanted to think about what would happen if the assumptions were wrong. It was easier to believe they weren't. It was more profitable to believe they weren't. In the weeks leading up to October, there were more warning signs, more tremors. Stock market rallies would suddenly reverse. Then they'd rally again. It was like watching someone walk toward a cliff while blindfolded, occasionally staggering backward a few steps, then walking forward again. Each time they staggered back, someone shouted, "See? We're safe. The system works." But they were still walking toward the cliff. The cliff was getting closer. By late September, the cracks were becoming harder to ignore for anyone paying attention. Auto sales had started to slow noticeably, dropping from their summer peaks. Employment in certain industries was beginning to soften and shrink. Factory production was declining. The real economy, the actual production of goods and services, was showing signs of fatigue and stress that couldn't be explained away. But the stock market was still rising, still climbing higher, completely disconnected from these warning signs from the real world. It was as if two separate economies existed simultaneously, one grounded in reality and one existing purely in people's collective imagination. This is the nature of financial bubbles. The last stage isn't when prices stop rising, it's when prices keep rising despite every signal from the real world that something is wrong. It's when the disconnect becomes so obvious that everyone can see it, but nobody acts on it. Because acting on it means admitting you were wrong, and admitting you were wrong means taking losses. October 1929 started like any other week, but it wasn't. Monday the 21st was a significant down day. The market fell nearly 3%. People were nervous, but not panicked. The Fed and major bankers held press conferences and issued statements saying the situation was under control. They called it a healthy correction, the kind of thing that happens periodically. They promised stability and confidence. When you're on a sinking ship and the captain says it's under control, you don't immediately jump overboard. You wait and see. You trust the leadership. But Tuesday the 22nd brought more selling. Wednesday the 23rd brought even more. The selling was accelerating, building momentum. Thursday the 24th, which would later be called Black Thursday, the selling became absolutely frenzied. Panic selling, where people stop caring about the price and just want to get out. Just get out. Anything to reduce exposure. Brokers couldn't handle the volume of sell orders. The system was clogged, overwhelmed. Phone lines were jammed with calls from desperate people. The ticker machines that printed stock prices couldn't keep up with the trading, so prices printed on paper became obsolete almost immediately. People were selling stocks and then waiting hours to find out what price they'd sold at. By the time they found out, the price could have dropped several more percent. On Black Thursday, nearly 13 million shares changed hands. That was more than double the typical daily volume, more than triple in some cases. The system was breaking under its own weight, buckling under the pressure. By Friday and into the weekend, there was genuine terror in the streets and in homes across America. Margin calls started arriving like telegrams of doom. This is when a broker tells you to put more money into your account or they'll sell your stocks immediately. No negotiation, no mercy. But if your stocks are already dropping in value and you don't have more money, the broker sells them anyway, at whatever price they can get, which because of the panic is usually a terrible price, a price you would never accept under normal circumstances. This cascade of forced selling pushed prices down even further. Each drop triggered more margin calls. Each new round of margin calls triggered more forced selling. The vicious cycle that had built up prices so carefully over years now worked in reverse with terrifying speed. That weekend was supposed to be a time for relief, for digestion, for people to think clearly. Instead, it was a time of pure terror. Families sat in their homes wondering if their savings would survive the weekend. The Wall Street Journal ran a headline over the weekend trying to be calming. Crisis passes away, stock prices in sharp rally. It was whistling past the graveyard, denying reality. Everyone could feel something had fundamentally broken. You didn't need to be an economist to understand that if Thursday had been that bad, if nearly 13 million shares had traded and the system had nearly collapsed, Monday would be worse, much worse. There was no mechanism to stop it, no circuit breaker, no pause button. The buying power had evaporated. The margin loans that had lifted stocks up were now being called in, withdrawn, demanded back, and most importantly, confidence had cracked. When confidence breaks, it doesn't come back quickly. It takes a long time to rebuild, if it ever returns at all. Monday, October 28th, 1929, which became known as Black Monday, was the day the system came apart completely. Over 9 million shares traded in a single day. Prices didn't just fall, they collapsed. The market dropped nearly 13% in hours. People lost fortunes that they'd thought were solid and permanent. Bank accounts that had been growing month after month suddenly shrank in an afternoon. Brokerage firms that had seemed like permanent institutions, monuments of the financial establishment, suddenly faced insolvency. In those final hours of trading on that day, there was pure panic, chaos, terror. The stock ticker machines ran until 7:08 p.m. that evening just trying to catch up with the volume of trades. The system was so overwhelmed, it took hours for the ticker to process everything that had happened. By the time prices printed on the ticker, they were already obsolete, already hours old, already meaningless. The actual prices on the floor were far lower. The disconnect between the printed price and the actual price was like watching your wealth evaporate in a slow-motion disaster film where you're powerless to stop it. The people who'd bought on margin, the ordinary people who'd mortgaged their future to participate in the boom, faced total annihilation. This is the part that's hard to understand for people today. A man with $10,000 in stocks bought on $1,000 margin didn't lose his $1,000. He lost his $1,000 and owed the broker $9,000 more. You could go from thinking you were wealthy to being in debt all in one afternoon. Some people took their own lives that week, unable to face the reality of what had happened. Some disappeared, ran away. Some simply sat in shock, unable to comprehend what had happened, staring at the newspapers in disbelief. The brokerage firms started failing almost immediately. Some of the biggest names on Wall Street, firms that had seemed like monuments of permanence and stability, firms that had been in business for decades, simply couldn't meet their obligations. They'd lent too much money. They'd taken too many risks. Now they couldn't collect. The banks that had financed the margin loans started taking massive losses. The cascade of failure spread outward in all directions, touching everything. What people didn't fully understand in the days and weeks after Black Monday was that this wasn't just a stock market crash. This was the beginning of a chain reaction that would destroy the entire economy, destroy the entire financial system, and create hardship that would last for a decade. Banks failed because their assets were gone. Their holdings of stocks had evaporated. Their balance sheets became negative almost overnight. Businesses couldn't get credit because the banks were failing. The credit that had fueled the economy dried up. Businesses that had been expanding couldn't expand anymore. Workers got laid off because businesses couldn't operate or couldn't pay them. Families lost their homes because they couldn't pay mortgages to banks that were failing or demanding payment. And with each round of failure, confidence in the system eroded further. It was a downward spiral that seemed to have no bottom. Everyone who'd invested on margin got wiped out completely. Their life savings, their nest eggs, their dreams of a secure future, gone. Everyone who had savings in a bank was nervous, terrified really, about whether the bank would still exist next week. Would they be able to withdraw their money? How long before the bank closed its doors? Everyone who had a job was wondering if it would still be there. Every factory worker, every clerk, every salesman wondered if they'd still have employment in a month. The optimism of the 1920s, the belief that the future would always be better, that you could get rich quick, that the party would never have to end, evaporated like morning dew in the sun. What replaced it was fear. Pure, corrosive, paralyzing fear. Fear that made people make bad decisions. Fear that made them hoard cash. Fear that made them withdraw their bank deposits. Fear that destroyed the very institutions that were supposed to protect them. What makes the 1929 crash particularly instructive is that the warning signs were visible beforehand. There were people, serious economists and financial minds who saw what was happening and tried to sound the alarm. They were ignored because the incentives were all wrong. The people making money from the bubble had powerful reasons to dismiss the warnings. The people caught up in the speculation had emotional reasons to ignore them. The institutions that could have acted to stop the bubble had their own conflicts of interest. This is the pattern that repeats across every financial disaster. Someone always sees it coming. The warnings are always there. But warnings are noise, and the sound of money being made is louder. The key insight from 1929 is that financial systems are fragile when they're built on confidence rather than reality. When what things are worth depends primarily on what people think they're worth rather than on their actual productive capacity, the system becomes vulnerable to confidence shocks, and confidence can shift in an instant. All it takes is for enough people to realize that something is wrong, and the whole structure collapses. The Great Depression that followed 1929 lasted over a decade. Unemployment reached 25%. Entire industries shrank to almost nothing. Families that had been middle class became impoverished. The optimism of the 1920s turned into the despair of the 1930s. It took World War II to finally pull the economy out of the Depression. And even then, the recovery wasn't because of market forces. It was because the entire economy was mobilized for war production. This is what happens when a financial system built on speculation finally snaps. The people who did well after 1929 were the ones who saw it coming and got out early, liquidating their stocks before the crash accelerated. They were the cautious ones, the skeptics, the ones who didn't believe the story. Or they were the ones who had wealth in real assets like land or physical goods rather than stocks and margin accounts. They weren't hurt by the crash because they had something real, something tangible, something the market couldn't erase. The people who were destroyed were the ordinary people who believed the story that stock prices could only go up, that you could get rich quick, that participating in the boom was the smart move. History showed, as it always does, that this story was wrong. Completely wrong. The tragedy isn't that people were fooled. People have always been fooled. The tragedy is that this same story gets told again and again across different bubbles and different eras, and people keep believing it because the incentives remain the same. As long as there's money to be made from telling people they can get rich quick, someone will tell them. As long as people desperately want to believe it, they will. And as long as belief drives asset prices more than fundamentals do, the system will remain fragile, vulnerable to shocks. The 1929 crash was not an inevitable disaster that nobody could have predicted. It was a completely predictable consequence of a financial system that had become unmoored from reality, and a society that was willing to believe comfortable lies rather than confront uncomfortable truths. The signs were all there, the warnings were clear, but the sound of money being made was louder than the voice of caution. The final hours before that crash were filled with people still believing those comfortable lies, still buying stocks they couldn't afford, still convinced that the party would never end. History doesn't forget these moments. It remembers them as warnings. Whether we learn from them is another question entirely. If this story of financial collapse changed how you think about markets and stability, if it gave you a new perspective on how fragile systems can be, make sure you're subscribed, because these patterns repeat again and again across different eras and different economies.